A REIT is considered to be hybrid if it invests in both, and there are no correct answers to this question. But I think I know what the author of the question was trying to get to. A hybrid REIT will have investments in real estate and in mortgage-based securities. So it will invest in both equity and in debt related to real estate, not REITs. In other words, a REIT is not hybrid if it invests in equity REITs and mortgage REITs. Take out the word REIT. A REIT is considered to be hybrid if it invests in both the equity of real estate and in the debt of real estate. A direct private real estate investor can reduce taxable income using double taxation. Well, there is no double taxation if you are investing directly. There is no tax at a corporate level that finds its way down to an individual level. Usually you can avoid double taxation with REITs. A REIT structure will have no taxation at the company level, but that would be indirect investing. We're looking at direct investing. Get rid of a cash depreciation expenses. Well, this is wrong because cash and depreciation is a non-cash expense, so get rid of that. Tax deductible interest expenses. The main appeal of the REIT structure is the elimination of dividend distributions. No, the REIT structure invokes dividend distributions. There must be dividend distributions, and get rid of that. Is the elimination of double corporate taxation. Yes, there is no tax at the REIT level if a certain amount of EPS is passed through, a certain amount of the earnings are passed through to the shareholders. The corporation pays no tax, and the shareholder would pay tax at their marginal tax rate. The requirement to report an earnings per share. Well, that is, if you have a REIT structure, you do not eliminate this. This requirement is part of the filing requirements of the jurisdiction in which the REIT reports. It's not necessarily a function of the REIT structure. B. An advantage of REITs is low non-cash depreciation expense. Well, you got that part right. It's non-cash depreciation, but you didn't get the low right. It is high non-cash depreciation expense. If it were low non-cash depreciation, that would not be an advantage of a REIT because you lose that tax shield. Let's get rid of that. More transparency than private real estate markets. That is true. Lower correlation with public equity markets compared to private real estate. Actually, it ends up being higher because it is publicly traded, so it is going to have a more significant beta component than private real estate. Which of the following tends not to characterize real estate investments? Predictability. Well, that is a characteristic of real estate investments because you have leases. And you have leases, and within the lease, it'll tell you what the escalators are per year, how much the rent goes up per year. And it is for a number of years. So given a building, you should be able to predict out what the rental revenue will be for whatever the average life of the leases are. So you get predictability. We're looking for a not. We must get rid of that. Protection from inflation. You have protection from inflation in two ways. Rents. The escalator for rents might be tied to an inflation metric, and as inflation increases, it does push up property prices. So both your net operating income and your property prices would increase. And we're looking for a not. You would get protection from inflation. We have to take C, high correlations with other asset classes. Akasaka Investment Company established a portfolio of warehouse properties with a total market value of $3.6 billion. It secured mortgage financing of $2.61 billion. The terms of the mortgage required Akasaka to maintain a loan-to-value ratio of 0.725. After 18 months, the portfolio had dropped to $2.23 billion, and the mortgage liability was $2.35 billion. So we can see right away that you owe more than the property is worth here. By how much must Akasaka reduce its mortgage liability to return its loan-to-value back to the required level? And it's simple enough. You can take the 2.23 and multiply it by the 0.725. So this is the loan-to-value ratio. 0.725 is the loan-to-value. X being the loan, solve for the loan, it has to be 1.61675 billion. If it was 2.35 billion, or it is currently 2.35 billion, you got to get it down to 1.61. Means you're looking at 733,250,000, and it is none of the answers provided. So I had to look at the answer and say, well, what went wrong here? And I no longer ask myself, what did I do wrong? I say, where's the mistake in the book? See this 2.23? The answer uses 3.23 instead of 2.23. Unlike appraisers, equity investors tend to place heavy emphasis on recent trends, discounted cash flows, or current market conditions. We know equity investors look at discounted cash flows. If you're appraising a property, you will look at recent trends and current market conditions as opposed to discounted cash flows. But equity investors say, well, there's a stream of cash flows associated with this property. Let's value that. The present value of that should be the value of the property. Infrastructure investments can be categorized based on the nature of their underlying assets as economic or social. Yes. Local, regional, or national? Well, you can have economic infrastructure at all three levels or social infrastructure at all three levels. Usage-based or take-or-pay, and this relates to how the cash flows are generated from the particular asset. So you can have a particular asset with this either as usage-based, or the same asset could be a take-or-pay cash flow structure. Okay, this question has two answers. Which of these would most likely appeal to an investor who wants long-term stable returns? Greenfield investments, brownfield, or secondary stage investments? You know, you can make the argument that all three are correct answers. Because you're talking about long-term stable returns. Well, a greenfield investment could, after it's built and scaled up, provide long-term stable returns. But if you're looking for that right out of the gate, you're not going to get that with greenfield investments. You're going to move into brownfield investments, which is an existing infrastructure asset that needs to be expanded or upgraded, and there's already existing stream of cash flow associated with that. You can also get long-term stable returns with second stage investments, which means you have an infrastructure asset that doesn't have to be upgraded or expanded. So take a toll highway that you have a public highway that goes through a city. Let's say the city looks like this and it's always crowded. Look how unhappy that looks. I just drew an unhappy looking frog face. I didn't realize that till I just did that. Anyways, you would then create another toll road that branches off from here and just goes above all of that and bypasses it. Well, once this is built, it may not require any more upgrading or expanding, just the general maintenance that all roads require. Look at this, the frog is now screaming at me. That's a second stage investment, and it does provide long-term stable returns. So both of these are viable answers. I think what the author is getting at with brownfield investments is in the reading there is a sentence that says specifically this appeals to investors looking for long-term stable returns, but that sentence is not present with second stage investments. However, just because it's not written down doesn't mean it's not true. It is true. So there are two answers to this question, and the frog, let's do this here, and the frog agrees. Which of the following is true regarding infrastructure investments? They cannot be made using publicly traded securities. Well, yes, they can, so we know that that is not true. Master limited partnerships minimize double taxation for investors. That is true because it is a partnership. All income flows through to the partners. That is true, and we're looking for true. Large pension funds are frequent members of direct investment consortiums, yes, because of their preference for a shorter-term horizon, or a short-term horizon. Preference for a long-term horizon. I don't think that that is much of a test on anything. That's just, kind of a lazy answer on that one, but there we go. We have to take B. Which of the following types of infrastructure investments entails the lowest expected risk? Well, greenfield is starting from just a green field, basically. That has the highest level of risk. Brownfield, there's an existing asset. Remember, you're just expanding that existing asset, so the risk lies in the expansion phase, whether or not it can generate the revenue to overcome the investment. Where a secondary stage, you simply just have an investment that does not need any further investment, and it's generating cash flow. There you go. Secondary stage investments, lowest expected risk. Which of the following has the highest weighting to current yield? We have two that are greenfield, one that is brownfield. You're going to have to take the brownfield. Remember, greenfield, if we're thinking about a timeline and you're thinking about cash flows, it's a build-up to cash flows, right? Whereas we're thinking about brownfield, there already are existing cash flows. Question is, can you get those cash flows higher with extra investment? But they already exist. So there already is a current yield. There's no current yield on greenfield sites, so since A and C both have greenfield, that makes it easy. B. Compared with similar fixed income instruments, infrastructure debt has higher recovery rates, which is true. That is the answer. If you didn't know that it was, you could get there another way. Experiences higher default rates. No, it experiences lower default rates. You got some government backing in there. Has more fluctuations over the economic cycle. No, because they're infrastructure assets, especially the social ones, probably have far less fluctuation over the economic cycle. A.